Now, here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Coming up, we have exclusive new details of the police investigation into the former Chief of Staff of NAB Chief Executive Andrew Thorburn. Chief Business Reporter Leo Shanahan will share the details. Superman Greg Combet is now one of the most powerful people in the super industry after being named chair of IFM Investors and Industry Super Australia. My TV exclusive with former politician and union leader just ahead. And 3 of the big 4 banks have their AGMs this month, facing shareholders as they come out of the latest 2-week grilling from the Royal Commission. We'll find out what to expect with Brett Lemessurier from Shaw & Partners. Well, Brexit watchers may have thought that the British Parliament vote on 11 December was the next milestone, possibly even Brexit in the bag. But boy, big news today as a 5-day debate on Brexit kicks off. News that has really upended the Prime Minister Theresa May's mission, really. For the first time in history, government ministers have been found in contempt of Parliament for refusing to make public the legal advice on the so-called Irish backstop, and in particular the lack of autonomy that Britain would have if it could not agree with Europe in 2020. Oh dear. There's yet another lesson in the cover-up being rather more damaging than the facts. Brexiteers, Remainers, the DUP in Northern Ireland, the Scottish Nats, Labour and many Tories are furious in the lead-up to the Brexit vote on Wednesday week. The fate of Britain now swings between the wafer-slim chance of a May Brexit to a somehow renegotiated harder Brexit, or to a no-deal crash out of the EU, or another referendum, or even a vote of no confidence in the Prime Minister brought on by Labour. Overnight, Prime Minister Theresa May's call for unity seemed to fall on an increasing number of deaf ears.
We need to deliver a Brexit that respects the decision of the British people. A Brexit that takes back control of our borders, laws and money. And a Brexit that sets ourselves on course for a better future outside the EU, as a globally trading nation in charge of our own destiny and seizing the opportunities of trade with some of the fastest growing and most dynamic economies across the world.
Well, look, also the Prime Minister lost 3 votes within a couple of hours of Parliament yesterday, a feat not matched since Labour's Jim Callaghan in the 1970s managed to lose 3. Well, for the Brexiteers, Theresa May didn't listen. She had it her own way. Indeed, like the last female Prime Minister, Maggie Thatcher, she invoked Tina, there is no alternative. But Iron Lady Theresa May is not. For Brexiteers, Theresa May is delivering a little Britain, a vassal state where the UK remains a part of Europe's trading rules, unable to do deals freely outside of Europe, and yet with no say on any future rule changes on trade within the EU. Even US President Donald Trump quipped as much recently. A lot of people feel there are now a plethora of mistakes made by the Prime Minister along the way which have boxed Britain onto the ropes. Her decision to call a general election in 2017 was a disaster, making her majority dependent on the DUP in Northern Ireland. Secondly, by not committing to spend at least some money on preparing for a hard Brexit, investment in the Dover to Calais crossing, for example, she then weakened Britain's negotiating position. Prime Minister also chose Ollie Robbins, a well-known Remainer and Europhile, as her chief advisor. She agreed to that £39 billion payment to Europe without really securing anything in return, and she settled for this Irish backstop, a fudge. Well, if you read the British papers, there's a growing criticism that she's also misled the people in order to bring them with her, which is a recipe for disaster. In her Lancaster House speech back in January 2017, Mrs May said the UK would leave the single market and the European Court of Justice. It would have a customs deal and still be able to make its own trade deals. But it turns out that Mrs May's deal will not end the jurisdiction of the European Court of Justice in the UK. The soon-to-be-revealed legal advice will no doubt demonstrate this in black and white. And no, the Northern Ireland backstop is not just a mere technicality. At Lancaster House, she said, no deal is better than a bad deal. And yet, what is offered up in Theresa May's deal for the vote on 11 December is roundly regarded in Parliament as a bad deal. One is reminded of Lord Salisbury. Change? Change? Aren't things bad enough the way they are? Well, moving on now. And look, we've got new information on an Australian story. New information on the police investigation into the former Chief of Staff of NAB boss Andrew Thorburn, with details of a new intervention by the New South Wales Crime Commission. Your Money Chief Business Reporter Leo Shanahan can also reveal that police are investigating an extraordinary amount of more than $110 million handed over to the Human Group, currently under investigation for giving kickbacks to the bank. Joining me now, Leo Shanahan, for more on these developments. Leo, tell us about this breaking story. I mean, this is really interesting. First, in terms of what's going on with the individuals involved.
Yes. Now, Rosemary Rogers, the former Chief of Staff of the NAB Chief Executive, Andrew Thorburn, is under police investigation as part of this kickbacks bribery scandal. It goes to the heart of the bank. Now, there were raids in April this year on the Human Group. This is a company that provided corporate services, corporate retreat and travel services to NAB. And what police are investigating, New South Wales Financial Crime Squad are investigating, is whether there was bribes given in order for the Human Group to maintain contracts. Now, I can reveal this evening that Rosemary Rogers' bank accounts, the NAB, have been frozen under an order by the New South Wales Crime Commission. Now, notices were given to her at her Melbourne home yesterday, as well as NAB's Melbourne offices yesterday.
Has she been charged?
She has not been charged, and I should reiterate, there have been no charges laid against Ms Rogers,
right.
And we're not suggesting she's engaged in any wrongdoing, only that she's being investigated.
Yeah, and presumably Andrew Thorburn as well. There's no suggestion.
There is no suggestion that Andrew Thorburn is being investigated at all or as a suspect in any of this.
Okay.
So he's not being investigated.
Yeah.
But the New South Wales Crime Commission, who specialise in freezing of assets as part of criminal investigations, have frozen her accounts, the NAB, and instructed the NAB to freeze her accounts, possibly others.
And we do know that there was, I mean, presumably there was a relationship between these two women, Rosemary Rogers and the CEO of the Human Group, in terms of organising whatever services the Human Group were offering. I suppose what's staggering is the size of this money, isn't it?
Over 10 years, NAB handed over $113 million to the Human Group as part of corporate travel arrangements. Now, how much of that was spent on corporate travel? Well, it remains to be seen, but there is some extraordinary detail coming out. I mean, some of these trips, all first-class trips by leading executives. Well, many of them, I understand, were first-class. One, for example, to Dubai, where they were then helicoptered after a first-class trip into a desert oasis in Dubai. Many of these trips, of course, attended by current CEO Andrew Thorburn. I reiterate that he's not under any investigation. But the amount of money here, this is $10 million, more than $10 million on average per year in the last decade, handed over to this Human Group and spent on corporate retreats. You've got two major issues here. One is corporate largesse at the bank, and the other is a criminal central issue.
And look, you know, just the mind boggles, doesn't it? What on earth do they do when they get out there, and why does it need to be in Dubai, in the desert, after a helicopter ride?
Yes, and I think the details that come out of this case are going to be particularly damaging for the bank, not because of necessarily well, no suspicion by Andrew Thorburn. However, it did happen under their nose. Why wasn't it picked up sooner?
It's the optics of this, isn't it? The largesse, apart from any freezing of assets, which, you know, is just a fact today, it's the optics of it all.
Exactly. I mean, you've got this incredible amount being spent on corporate retreats, over $10 million a year at NAB, and it turns out well, there is now a criminal investigation to whether they're receiving kickbacks. How does this happen at one of Australia's largest banks?
Good question. Leo Shanahan, thanks very much for that breaking news. Right. Well, let's move on. Greg Combet, the former Energy and Climate Change Minister under Labor and a former union chief, has today become one of the most influential people in the $2.7 trillion super sector. Today, Mr. Combet was named chair of super funds management company IFM Investors, which looks after a whopping $113 billion in retirement savings for industry funds. And he's also become the new chair of Industry Super Australia, which manages the sort of research, policy, lobbying side for industry super funds generally. It has been a year of more and more clover for Industry Super, which in June overtook the bank-owned retail funds in total funds under management. And the flows from retail to industry funds continue after the shocking revelations of gouging by retail funds were revealed in that Royal Commission. But Industry Super is not immune to influence, including union influence. So what does the new leader make of governance and the putting of members first in his new role? Well, I spoke exclusively with Greg Combet a little earlier. Greg Combet, congratulations on the new roles. You've got to be the most influential force in super now. Halcyon days for Industry Super, of course. That's quite a responsibility.
Oh, it is, and thank you, Ticky. It's a great privilege for me, and it is a responsibility, of course. I don't know about how influential I'll be, but they're nonetheless very important roles, and I'll be focusing firmly on my objectives over the next few years in both of those roles.
Just looking at IFM Investors, it's such an extraordinary model that people are now trying to get their heads around, run by Brett Himbury and people like Carl Mangini. How do you see IFM's role?
Well, firstly, as you said, it's a hugely successful initiative owned by all profit to members Australian industry super funds, and as partly as a consequence, of course, of the retirement savings system in Australia growing so much. It's now about $2.7 trillion in savings, projected to grow to about $6 trillion by 2030, and significantly outstripping the size of Australia's gross domestic product. The industry funds need to be looking globally to invest, and IFM Investors has led the way with that under Gary Weaven and Brett Himbury's leadership and Kyle Mangini's, as you mentioned, in recent years. And it is a successful model because it's a quite unique funds manager. It's completely aligned with the interests of its clients, superannuation and pension funds and like-minded institutions, with the ultimate purpose of delivering superior net returns to the beneficiaries of superannuation and pension funds. And it's been successful in that regard. But of course, as well as accumulating capital, you need to deploy it successfully to earn the returns, and IFM has a strong record in that respect.
Now, the asset classes you guys are investing in, you talk about the importance of the long-term infrastructure and indeed private equity. I'm wondering whether you believe that there will be a major shift because of this long-term investment and performance. A lot of these listed stocks might be actually taken off the boards.
I don't know that I'd speculate in that respect. Certainly there's some take-private initiatives underway at the moment, and you could expect that to continue to occur, and obviously not just from industry super funds. It's a feature of the market we've seen for a long period of time, of course, but it is the case that institutions like IFM Investors and our clients will be looking for unlisted equity opportunities, and that'll be in infrastructure, where we've laid a great platform in Australia and globally, but also in other unlisted equity and private equity. And with the pool of capital that's available, it can be put to work, and put to work with a longer term focus and with a awareness of the responsibility to the society and the economy and the workforces involved. I mean, that's the distinguishing feature of the industry funds and IFM Investors as a funds manager. Longer term focus and socially responsible investment that delivers superior net returns for the members of super funds, but also delivers on an economic basis too. So we'll certainly be looking at unlisted equity opportunities in the future, both domestically and globally.
Greg, one of the stakeholders in IFM Investors is Aussie Super, obviously a very, very important one. Now, what if Ian Silk decides that Mark Delaney can do this a little better, or at least just as well as IFM Investors? They've got a huge amount of money of their own to bring expertise in-house. Rather than IFM Investors just clipping the ticket, will there be any tensions there going forward, do you think?
Australian Super is the largest shareholder in IFM Investors, I guess, first point. very large client, obviously. We manage a very significant proportion of Australian super's funds under management in the various asset classes that we offer. So there's a very close relationship for a start. Australian super is now about 140 billion funds under management, Australia's largest super fund. IFM's about 114 billion funds under management, a lot of that deployed globally. They're two growing organisations with a long history, a similar set of values and objectives, and they will work together as both of the organisations evolve, and there's pretty regular discussions about how to do that. And given the scale of the retirement savings system that I described earlier, I think we'll be increasingly doing that globally. We work together closely in the domestic market.
But you don't see tensions emerging there?
Oh, look, there's a bit of, robust discussion, I think it's called, from time to time. However, look at the evidence of how we've managed that. We are partners in Ausgrid, the largest utility in the country in New South Wales, and we've got operational control of that asset and working together on that. We're also actually competitors in the WestConnex bid. Australian Super partnered with Transurban and were ultimately successful. IFM investors led an alternative consortium, but I wouldn't say there was tension in that. We understand with the scale that both organisations have reached that we'll be in that situation from time to time.
Can I move on to the Royal Commission and disgraceful revelations around for-profit retail funds, just like the Fox and the Hen House, and not just from Kenneth Hayne, but also the Productivity Commission. Unions will now take to the ALP, the Labor Conference, that profit for retail funds should be banned altogether. Do you agree with that?
Oh, well, that's not the policy position of the industry funds, but we do understand the arguments that the ACTU and the unions are making in that respect. I mean, and it's pretty obvious why. There's been a conflict in those retail funds, the bank-owned funds and AMP in particular, between shareholder interests and the interests of the members of those super funds, and looks like shareholders have won out on that front. The products have been distributed on a conflicted remuneration model that's clearly not in members' interests. So there's significant problems been unearthed there that we've been arguing existed for a long time, and that's a contributing factor to the underperformance of the retail funds relative to industry funds, which have outperformed them over a long period of time by about 2% per annum. So there's problems there. I can understand why the ACTU is arguing that, but I don't think mandating a particular model is really the approach. What we need to do is look at the system and look and find the consistently underperforming superannuation funds, for example, those that might have been in the bottom quartile over a very extended period of time, and start to rationalise the number of funds that are in the system and weed out consistent bad performers that are not serving the members of interests the best that could be.
Looking at power and influence on boards, this week in the US, Jack Bogle, he's the former chief of Vanguard, which is a mutual profit for member organisation. Now, he's warned that these sorts of funds may become too successful for their own good. Just a handful of investment companies end up controlling every corporate board and shareholder vote. Is that a danger in what might happen with the growth of industry funds in Australia, do you think?
I think we're a very long way from that being any risk. It's a very large, capital market in Australia, and many institutional investors. I mean, the combined funds under management of the industry funds is about $640 billion, and multiple managers are engaged by the industry funds as well as other institutions in the country. In a range of asset classes. I don't think we're at risk of that sort of concentration, certainly at this point in time.
OK, but more broadly on the influence that you might have, for example, do you agree with former TWU National Secretary Tony Sheldon that trustees of super funds should be able to use their positions to withdraw companies engaged in what he calls wage theft and tax rorting? I'm
very committed and have been throughout my working life. I've been involved in super for a long period of time, including, of course, as a trade union official. And there's one purpose here, and that's the objectives to serve the members best and serve them first, you know, to get the best.
So you agree with AIG's Innes Willox on this, that it is a dangerous road to go down, because you potentially, I mean, if you follow Mr Sheldon's line, you could actually be impacting the incomes of millions of workers.
Well, I've sat on the board of the joint trusteeship model industry super funds, and they are a partnership between the employer community and various industries and union representatives. And the thing that's really successful about that model, Ticky, is the focus on members' interest. You know, that they're there to serve the interest of members and to derive the best returns available. That doesn't mean that you don't look at your investments from a long-term and a socially responsible or an environmentally responsible or a workforce responsible point of view. That certainly occurs, but the overriding first priority must be members' interest and delivering those returns to members. And I'm always cognizant of the arguments that are raised by people like Tony Sheldon, who I know well, but I'm also super committed that we remain focused on members' interest and we don't derogate from that in any way.
Greg, just a couple on the ideological front. Look, the Liberal government failed spectacularly, I think, with the Building Royal Commission. It had very few scalps. They've now dropped opposition to union representation on industry super boards. We know about power and we know about absolute power, especially where money's concerned, Exhibit A being the big four banks. What are the lessons here, do you think?
Oh, I think of recent years, but it's gone on for many years. There's been this sort of ideological contest over the industry super funds. They're called union funds by the conservative side of politics time and time again. They're not union funds. They're a partnership between the employer community and trade unions, and they are successful. And what we've been arguing for so many years now has been validated by the Productivity Commission inquiry, been further validated by the Royal Commission evidence that we've seen about how the retail funds perform. So it is a successful model, and I guess I think just as a country we need to put the ideology aside and think about how we best represent the members of the community and what successful model does that. And ensure that we're not engaged in an ideological fight, but that we're focused on the best interest of the country. How do we build it? How do we mobilise this pool of capital? How do we get the returns that enhance the retirement savings of Australian working people? That's the issue, and I'd like to put the ideological wars aside and focus on the important public policy initiatives that are guided by those principles, and in particular putting members' interests first.
It all goes to the crunch, though, doesn't it? I mean, if a shortened government were to come in May or indeed before, that the stars are aligned, aren't they? Bill Shorten, former ACTU, there's a fear that the people running the funds one way or another owe their careers to the unions, including yourself, on the Industry Super Board. In the Industry Super Australia Board sits Michael O'Connor. He runs the country's most powerful union, the CFMEU. You've got Sally McManus at the ACTU. Now, what's to stop the more extreme voices in unions having a massive influence here? And can people like you and perhaps Ian Silk make sure that that doesn't happen?
Common sense and accountability, people being responsible in the roles that they have. I mean, that's perfectly valid for people who hold a trade union position to argue forcefully on behalf of the people that they're representing and on the basis of their values in our community. But those of us who hold also a position in the industry super fund world, we've got very well articulated responsibilities under legislative and prudential arrangements, and we must faithfully discharge that. And being open and accountable and transparent in our discharge of those duties is very important, and I'm sure that people such as yourself will watch it closely and hold us to account. But there's 30 years of history that we're dealing with here, and I think, you know, if we just take a look at what's been achieved to date, the industry funds have been run very professionally, the investments have been made very professionally, the performance and the outperformance against competitors has been validated by the Productivity Commission now, an argument we've been making for a long time. we are longer term investors. We do put members' interests first, and that will continue to define us. And I wouldn't get too distracted by some of the sort of ideological obsessions, if I could describe them that way.
Well, Greg Combet, it is going to be a great time for investment, I think. So congratulations again. I do look forward to following you guys a lot next year.
Thanks, Ticky. Thank you.
And Clover they are at the moment, aren't they? After the break, what to expect from the AGMs of the three of the big four banks? Not in so much Clover. Shaw and Partners, Brett Lemessurier will join me next.
You're watching Ticky on Your Money. Now, back to Ticky.
Yes, welcome back. Well, the AGMs of three of the big four banks are almost upon us. Westpac up first next Wednesday, then NAB and ANZ both on the following Wednesday. Commonwealth Bank is, of course, held its AGM out of cycle on Wednesday, November the 7th, and investors didn't really hold back about their grievances. So what can we expect for the other three banks? We're hearing a REM strike may be coming for NAB's Ken Henry. Well, for more on just what to expect, let's bring in Shaw and Partners. Brett Lemessurier joins me from our main Sydney studio. Brett, what are you looking forward to and or fearing from these AGMs that are coming through?
Well, I'm sure there'll be lots of discussion and questions about the bank's performance at the Royal Commission, and of course the performance of some of the chairs at the Royal Commission, which weren't necessarily fabulous. You wouldn't say they covered themselves in glory, most of them. And of course also the remuneration reports are going to be an issue as well, as that was one of the issues that was highlighted at the Royal Commission, the remuneration generally of bank executives.
Brett, there's so much confusion over what the right structure should be. Confusion indeed when, you know, when some companies try to put up different sorts of structures, and the disquiet among shareholders as to, no, I don't like that idea either. I mean, how can boards move forward in remuneration?
Well, I think the real issue is that they deliver the right profit outcome given the risk framework, which means that there needs to be a balance between the profit that the banks achieve and the problems that are created. And basically, if you think about how long it takes for the problems to emerge, then you're looking at a structure whereby a substantial part of the remuneration is deferred for a number of years.
Yep.
And that also raises the difficult question as to what happens when executives leave before that time is up. So it requires some judgment on the part of the boards to determine what to do when someone leaves earlier than might have been expected.
Yeah, so I mentioned there that Ken Henry at NAB might be expecting a first strike on the remuneration report. Do you think that's likely, and any other strikes likely?
Well, you can never rule out strikes on remuneration reports these days. They do tend to becoming more numerous. And of course, when you've got issues surrounding profit performance and share price performance, that's going to intensify the pressure on the remuneration structures. The shareholders are going to say, why are you getting paid so much when our performance is not as good? Shouldn't you also wear some of the pain? But that also goes to the issue of short-term bonuses against long-term remuneration based on outcomes after the risks have manifested themselves.
Well, no doubt we're going to get a lot of people from the floor talking about their own personal experiences. I know that Labor, for example, is looking at getting many more individual cases up, because not many individual cases actually went through the Royal Commission. But that said, what about the broader issues and the outlook we're expecting from these boards on performance? Are we going to get much guidance as to how they're going to go in these much tougher conditions?
No, I don't think so, but I think there's a broad expectation from the market that banks are facing a tough time at the moment. And the share prices are reflecting that, and that goes to the low levels of loan growth that they're experiencing when you look at it in a historical context. And of course, house prices are one of the most significant issues that banks are facing when it comes to loan growth. Obviously, if house prices continue to fall, then loan growth will continue to be under pressure. But of course, there's been a lot of changes that banks have made in their underwriting standards for home loans. So it should be that house prices or the declines in house prices, particularly in Sydney and Melbourne, should moderate during the course of next year. But of course, much also depends on what comes out of the Royal Commission and any future changes that may be made to underwriting standards.
Changes too potentially on the horizon for franking credits. Now, if you're a shareholder of one of these big banks, are you going to be looking at, is that going to impact the banks at all? Are you going to be looking at any capital allocation changes, buybacks, that sort of thing?
Well, the banks would no doubt look very carefully at the balance of franking credits they had, and if there were law changes, then no doubt they would be thinking about how to return those to shareholders. But of course, the transaction just done for tax reasons is going to attract the interest of the tax office. So any scheme that they come up with would need to obviously have the sign-off of the tax office, because to proceed with the scheme without such a sign-off is just a waste of time.
Yeah, but no, I mean, there are companies all over the place in expectation of changes under Labor who are doing lots of sort of buying back of shares, or announcing them at least. If you're in a bank as an investor, might you get that sort of thing coming your way too?
Yes, but if you're returning capital and then raising capital on the other, the tax office would say, well, isn't this, aren't you doing this just to achieve a tax benefit?
Gotcha.
And there's substantial rules against that sort of behaviour. So if banks had plenty of spare capital and returned the franking credits as a consequence of that, then there's no issue. But if it's as a consequence of a tax scheme, then that would require detailed discussions with the tax office to get the right outcome.
So finally, of the three, are there anyone doing slightly better than the other? Would you pick one out?
Well, Commonwealth Bank, notwithstanding the problems it's got at the Royal Commission, continues to operate extremely well, notwithstanding those problems, notwithstanding the low home loan growth that the industry is facing. They maintain their margins and manage their margins on a historic basis, and they look like they're going to continue to do that better than their peers. So they do seem to be in a privileged and a superior position.
All right, well, we'll have a good look at the other three come the AGMs over the next couple of weeks. Brett Le Mesurier, thank you very much.
You're very welcome.
After the break, the UK government to be found in contempt of Parliament. I'll get some analysis from the CEO of the Australian British Chamber of Commerce, David McCredie.
This is Ticky on Your Money, covering the big business stories.
Welcome back. Well, as mentioned earlier, the British government has been found to be in contempt of Parliament for the first time in history over its refusal to publish the legal advice they'd received on Brexit. Lawmakers voted 311 to 293 in favour of the motion, which found Theresa May's ministers in contempt, ordering the immediate publication of the advice. Well, for more on the situation that will overnight unfold in the UK, I'm joined by David McCredie, CEO of the Australian British Chamber of Commerce, who joins me live from Melbourne. David, this is an extraordinary development, isn't it?
Yeah, no, clearly it's the first time in history, UK Parliament's been around for quite a while now, that this sort of action's been taken. So, you know, clearly to get the vote up to find them in contempt, they needed to have the numbers in the House of Commons, which is unusual because generally the government controls the House of Commons, and clearly that wasn't the case last night.
So a lot of disquiet obviously within Parliament then. What do we think is going to be revealed in this legal advice?
Well, it's interesting. I mean, the Attorney-General, Mr Cox, his view was that releasing the full legal advice would give too much away to the EU about potential future negotiation positions and what the UK believes it can and can't do going forward. So his view was that in the national interest that should be withheld. Clearly the House didn't agree, and so they've agreed to publish in full the legal advice that the government has received on the withdrawal bill.
So that would be two crucial touch points, presumably, the Irish backstop question, but also how much autonomy Britain would have at the end of the transition period to leave, were it to fall out with Europe on how that should be done.
Yeah, that's right. And it was interesting in questioning in the House yesterday. The Attorney-General was pressed on those sorts of issues. He made it clear that he didn't believe that the UK was in a position to unilaterally withdraw from the backstop arrangement if that were to come into play because of the agreement they're putting forward. Now, clearly that's not an ideal situation from a Brexiteer's point of view, who clearly don't want that sort of control, and Jacob Rees-Mogg, for example, was very clear that this was taxation without representation, not only for the transition period but also potentially into the future, which obviously isn't an ideal result, which has strengthened the Remainers' claims that they'd like to say, well, we can have representation if we just stay in the EU.
Yeah, well, they're really confusing now because where are we going, and how strong is the position of the Prime Minister?
Well, clearly the Prime Minister's in a very difficult position. She has been for quite some time, but the rubber's really hitting the road now. The meaningful parliamentary vote has been something that has been hanging over her head for quite some time prior to the deal even being struck and agreed between the Cabinet and also by the EU 27 leaders. So she's been in knowing that this juncture was going to come and that the numbers had to be found. At this stage, there are all sorts of people coming out of the woodwork. Mervyn King, the former Governor of the Bank of England, published a column yesterday. Mark Carney, the current Governor, slapped him down. There are people like Boris Johnson firing off without potentially giving any sort of clue as to what sort of future he would actually vote for or agree to. So you're right, it's a very confusing time. Keeping track of it all is a very difficult challenge.
Yes.
But I think the hope we have, certainly at this point in time, is that the vote we know will happen next week. There are 5 days set aside for this debate. There's been talk of that may go on till 5:45 a.m. There are numerous measures, and William Hague, indeed, Lord Hague, the former Foreign Secretary, wrote in the Telegraph yesterday about the challenges that await, and also talking a lot about how no deal really is unpalatable to more of the House than a deal. But the question is, will they be able to get the numbers to actually make that happen, or will enough people head more towards a Remain piece? What might happen if there are amendments? The EU's made it clear that this is the only deal. The Prime Minister's been very clear in that conviction as well. So, look, there are lots of things to play out. Hopefully, the vote needs to happen next week. Hopefully, we'll have some resolution then.
Briefly, if the vote does not get passed, what are the chances that Theresa May stays on, do you think?
Well, it depends. There's been a lot of talk actually in recent times that she may lose a first vote. That may be accompanied by some fairly drastic shifts in the markets, which might encourage a second vote to be passed shortly thereafter. And there was an interesting, again in the Telegraph last night, there was some interesting polling around people's first and second options, both from Remainers and from Brexiteers and from people who support the deal, and how they play out. People's first option is still rigidly which way they were at the referendum, but there are a surprisingly large number of people who see a deal and this deal as a reasonable second option rather than the alternative.
Well, very interesting. Right, you cover it so well. David McCredie, thank you very much for all your insights there.
My pleasure. Thanks, Ticky.
Well, back here now, GrainCorp getting an over $2 billion bid from this investment firm, Long Term Asset Partners. Haven't really heard about them very much. The company saying it will review the $10.42 a share offer while looking at other options to create value for shareholders. It comes amid a review of the company's portfolio as it aims to simplify its Eastern Australian operating structure. GrainCorp says the offer would be, quote, an initial investment for the new entity. The grains handler is not yet sure on whether the offer price is enough to preempt a change of control, telling shareholders not to take action at this stage. Well, for more on the story, Will Glasgow, he's editor of the Australian's Margin Call, and he joins me at the desk. Will, this is really, hello, this is a very interesting front page story you had. So who's behind this business? What is it? Long-term management?
Long-term asset management.
Asset management.
Yeah, so it's chaired by Tony Shepherd, a very well-known figure,
Oh, yes.
one of the best-known figures in Australia, in the business scene, former president of the Business Council of Australia.
Indeed.
So chaired by him, also on the board's Lance Hockridge, from the former Horizon boss, well-known as well. But the brains behind it is a guy called Chris Haddock, and, well, Chris Crash.
Crash, he's known as Crash, yeah. Why is he known as Crash?
Well, that's a nickname that Tony Shepherd's come up with, because there's a guy with the same name from a 1950s rockabilly band that apparently Tony Shepherd really likes, that I'd never heard of.
Not as you say that he crashes at everybody's places as well.
Well, he also is well known amongst a certain group of people in this, particularly the eastern suburbs of Sydney, for being a bit of a couch surfer, staying from place to place at various Macquarie executives, bankers.
So this is the guy who's now running this this new company, private equity company, which is looking at making a tilt at GrainCorp.
And a company that's never done a deal, was established purely to do this.
So what's that? I mean, if you are, never mind if you're a shareholder of GrainCorp, because presumably that comes down to price, because, well, a long time ago it was a co-op, wasn't it?
That's right,
This is what happens when you come out of a co-op. But what about the people who are using GrainCorp as a business? Because it was, who was dinged in the national interest when they took a tilt at GrainCorp?
Oh,
Archer Daniel Midland, yes.
So they were.
So what's actually going to happen if there was a takeover now? Would it be stripped back, and what it would do to service? What's the leverage involved in this sort of a deal? Do we know?
Well, the leverage, we know that their bid's got $3.6 billion secured from Goldman Sachs and from another Melbourne infrastructure fund to do it. So they say, we're good for the money, don't worry about the equity arrangement. But understandably, the GrainCorp board, which is chaired by Graham Bradley, another former Business Council of Australia president who knows Tony Shepherd well.
Those two go back for years.
They sure do, and he's the one who's been getting the call from Tony Shepherd, not from this mystery Crash figure. They've got to work out, well, what is this? What is this clever arrangement? You've got this, you say you've secured this funds, but how would it work? Who would actually own the business?
Yes.
Would it require a FIRB test, which is something they're very keen to know after the ADM experience?
Well, of course.
And currently they don't know, they say. So the bidding partner says, no, everything's fine, we've got the money, there's no FIRB problems. But GrainCorp really doesn't know. They're saying we need more information.
And GrainCorp has on its own mission, isn't it, to look at other assets?
Yeah, it's come out, you know, as often happens when there's a takeover, suddenly boards have lots to say about their own vision for the company, and why, you know, this bid, however lucrative, gets in the way of lots of money making schemes.
But I guess coming back to the customer and the ability to run the business well, it also comes back to how much money will be available to invest in the business, to grow the business. Presumably we've got to hear from this new mob exactly what it is.
Well, what it is, who would actually own it? Beyond, we know this sort of a bit about this clever debt arrangement that Chris has been kicking around for almost 2 decades. He's been thinking about these kind of schemes, and you know, he's got no track record on doing any deals. If he pulls this off after his sort of the kind of void on his CV, it will be the most amazing business story that this guy, for his first bid, his first ever deal, did a $2.4 billion takeover of this iconic Australian business. Or, if it doesn't, this could go down as, we might in 6 months be saying, what the hell was that? What were they thinking?
Well, what an extraordinary story. Right, well, obviously we've got to find this fellow, or indeed Tony Shepherd, and have a word with him.
Sure do.
Thank you, Will Glasgow, very much for that great story. OK, after the break, what to expect from the OPEC meeting happening tomorrow in Vienna, we'll find out. Saul Kavanagh from Credit Suisse joins me next.
Now, back to Ticky.
Welcome back. Well, let's hit oil. Oil is retreating after riding its biggest two-day gain since June, after Saudi's oil chief signalled OPEC and its allies have yet to reach a consensus on whether supply curbs are in order. It comes just days after an agreement between the Saudi Crown Prince and the Russian president, remember that high five, which looked to clear the way for a production accord. The OPEC meeting is set to kick off in Vienna on Thursday afternoon, and while there seems to be a vague outline of an agreement in hand, there's still quite a bit of uncertainty about what might come out of that meeting. Well, let's get the view of somebody who will know more than anyone about just what might happen. Saul Kavanagh, Head of Equity Energy Research at Credit Suisse, joins me live at the desk. So it's always very difficult. There have been a lot of pre-meetings, haven't there?
Indeed, and all eyes are on OPEC tomorrow. If we kind of look at what's going on here, the market is expecting, and the analysis suggests a need for a cut of between 1 and up to 1.5 million barrels a day.
Wow.
And extent, we're looking at a deja vu situation back to 2014, which was right before oil prices collapsed. And because what's one of the big drivers here, I mean, we've had the Twitter-driven politics coming out of Trump, which has obviously been pushing things down, but really the fundamentals here is still about an influx of record-breaking US shale oil supply.
Well, I was going to ask, how relevant is OPEC these days when you bring US oil shale into the...
Well, that's what OPEC is struggling with. So clearly they're relevant in the sense that they're the biggest block of supply which has control. And this is what contrasts with the US, where the US is an unregulated market with hundreds of players, all of them doing their own, having their own corporate drivers, and in essence has no control. And so when we look at tomorrow, if we look at what happens if there is cuts, then we can see some stability in prices, and we're expecting prices will remain above $60 Brent.
Yes.
But if we don't see those cuts, or we only see a tentative announcement of cuts, we could see prices drop. And the reason prices are dropping are people think we're going to have to see a reduction in WTI prices in the US to reduce investment in US shale spend. But the problem we have there is, even if we see WTI well below $50, because of hedging positions, because of existing contractual commitments, and because you have all these smaller players in the US who continually overinvest regardless of what oil does, because they're incentivized to make production growth over the necessarily short-term economics, you're unlikely to see a big reduction in US shale growth over the near term. And so even with cuts of 1.5 million barrels from recent high from OPEC, we're still looking at stock builds in the first half of next year, only to rebalance in the second half of next year. That said, it's worth pointing out the risks here. The waivers on US sanctions will come up for renewal in about 5 months' time. And if you look on average over the last 2 years, you've seen 500,000 barrels a day of unplanned outages. So when you factor those two things together, an implied stock build of 1 million barrels a day next year is actually could be seen as healthy, having that in storage to be there in case you see these unexpected supply disruptions.
So if I'm an airline, how is my next 12 months going to go, do I think?
Look, I think your crystal ball on oil prices is as good as mine. When we look at it in an equity market perspective, we want to look at what companies are most robust to long-term downside in oil price, and then we're looking at a flight to quality.
Yeah. Okay, all right. Hey, look, so much going on in the sector. Let's talk gas first. News about Prelude, Shell's Prelude.
Shell has come out and said production will start at Prelude by the end of this year, or around the end of this year. So let's put some context around. This is a departure. The most recent guidance from Shell was material cash in 2018. So let's be clear, there will now be no cash in 2018. A production start...
This is the FLNG, yes?
This is the big almost 500 metre long, world's largest human-made floating facility offshore Western Australia. It is a pioneering technological breakthrough which has broken records on a number of fronts. Unfortunately, some of those records are not good records. And so if you look recently what's happened, I mean, they've recently had all their mooring lines snap when they've tried to do cargo loadings. They've now got the Bunnings boiler, it's being called, where in LNG facilities, your boiler kit, this is core kit. You can't go just buy it off a shelf.
Yes.
And one of them is in such bad condition, they've literally ridden it off and using it for parts.
So
dubbed it the Bunnings boiler. So we think our first cargo from Prelude is likely to be delayed well into at least the first quarter of next year.
All right. Okay. Now, import terminals, gas import terminals, which I think, honestly, I cannot understand why this is happening in this country. But there is one announced by, who are these guys in Newcastle? Epic? Who are they?
That's right. So a new proposal put out yesterday evening. They have an agreement with the Port of Newcastle, based out of Singapore. We don't know too much about them, but this is now the 5th publicly proposed LNG import terminal. We're at a genuine risk here that the east coast of Australia, after overbuilding LNG export capacity, now has plans to overbuild LNG import capacity. And what's a real struggle with this one is, while Newcastle is a great port, we think it's going to require significant augmentation and upgrades of pipelines all the way through to Sydney to actually get gas to end customers, depending on where they sit. And the reality is there is simply not enough market for all of these, most of these, or even arguably any of these proposals to go forward. But yet, people are moving in. The reality is we haven't seen industrial buyers sign term deals needed to project finance these import terminals. And why would they when they can get cheaper gas through the pipeline network and have hope that a new government next year could lower the prices for them further?
Well, I must say I'm rather with you. Sol Kavanagh, really interesting. Thank you so much for joining us.
Thank you.
Well, that's all for the show tonight. Now, tomorrow night, Ken Curtis, chairman of Starfor Investment Holdings, who has the inside scoop on the arrest of Nissan CEO Carlos Ghosn. Really interesting interview. I hope to see you at 4:30 Eastern Time tomorrow night, or tonight on Catch Up at 10 p.m. Thanks for your company.